All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny,
I'm Dylan.
and today we're going to talk about how Michael Burry is wrong. Okay,
Taking a shot at the king,
I
huh?
know, right? Like this is sacrilege right here, but we'll see. We're gonna walk through one of his investments that he made in the fourth quarter of 2020. You're going to talk, kind of break it down, a little bit of analysis of the company, where the future prospects are, and why I don't think it's a great long-term investment.
Oh boy.
Yeah, I know, right? It's going to be very fun. So there's the king, taking a little shot at the king, as Dylan said. But
Molson
everyone
Coors.
has their moment or different thoughts about stocks. That's the reason why it's fun and interesting to get into investing.
All right.
Yeah. So this is wellwisdom.com. This is the website that Dylan and I use to kind of like track famous investors and see what they're buying, what they're selling, that sort of stuff. Coming up on the season where we'll get the next quarterly filings should be coming out in the next few weeks. If you look at, like I said, the previous one, Michael Burry bought 150,000 shares of TAP, which is a Molson Coors Beverage Company, about 3% of his portfolio, at an average price of about $45 a share.
Yeah, that's a pretty good entry.
Yeah. I mean, we'll see the graph in a second. I'll be curious what the swing trader and you have to say about where it looked like on the graph there. Yeah.
That is 3% of his portfolio.
Yeah. I mean, he holds a lot of positions and he has pretty high turnover of his portfolio, but yeah, 3%, you believe in it if you put 3% of your money into it, because he is working with over a couple $100 million at this point.
Just a couple.
So this little green rectangle down here is where Michael Burry was picking up Molson Coors Beverage shares there, TAP, if you will. Looks like it's probably a pretty good swing opportunity. What do you think there, Dylan?
Yeah, I mean, this is a pretty good kind of double bottom here. I'd like to know where the 200 SMA is, but that's pretty solid.
Yeah, so the 200 SMA, I believe, is that black line.
Oh, I probably wouldn't have done it.
Yeah,
Never mind.
Yeah, I know, right?
Too scary for me.
Yeah, exactly. So Molson Coors Beverage Company, they've been having declining revenue for the last few years. They had a big bump up when they made the acquisition of the remaining 58% of Miller's Corporation that they did not own. Yeah, exactly. That's where you see that big bump up, but slowly kind of trending down over time after that. Okay. And then same thing with the profitability. They had a nice big bump up in profitability when they made that acquisition, but they've been kind of slowly bleeding off over time. They've even had some quarterly losses this past year. That was mostly related to write-downs in the value of their European brands, if you will. The core cash flow from Molson Coors Beverage Company was still positive last year in 2020, despite the whole COVID pandemic thing.
Right. Still trending down, but positive.
Still trending down, yeah. And this is something else as like a shareholder that I don't like seeing. They issued a lot of shares when they made that acquisition there of the Miller's Corporation, and they took on a lot of debt, but they've held it flat. They haven't had the ability to buy back any shares because they're still kind of drowning in debt from that previous acquisition.
Yeah, it's not great.
Yeah. So this is from the recent shareholder presentation. If you look at it, Miller Coors is now the 5th largest beer company in the world, which, sounds okay at first glance, but they were actually the 3rd largest at one point in time, right after that acquisition. They've been slowly kind of bleeding off over time, and, they're in terms of their sales and their market share, unfortunately.
3rd to 5th is a big drop.
Yeah, very, very much so. Pretty wide, diverse array of products there, if you will, though. I mean, I've definitely had some of them before. I've had Blue Moon, and I know they distribute Yingling. They don't make Yingling, though, but
I don't think I've ever seen any of these.
Yeah, there's
any of those are.
Yeah, they have quite a few. They also changed their name from Molson Coors Brewery to Molson Coors Beverage Company because they're trying to diversify into non-alcoholic drinks as well.
Right.
Yeah, so this right here is their hard seltzer line. Hard seltzer is big growth industry right now. Hard for them to kind of compete with the kind of market share there. So they came up with these 4 different brands, kind of just throwing stuff at the wall is what I thought, right, Dylan?
Yeah, a little bit of shotgun effect. They're hoping one sticks. What are the 2 big seltzers? It's Truly and
I forget, honestly.
White Claw.
White Claw, yeah. Truly is Boston Beer Company. I
Yeah.
remember
Okay.
that one. But yeah, they were a little bit late to the market. Topo Chico is interesting because it's actually a partnership with Coca-Cola, so they're not entirely alone on that one. Yeah, but they're throwing all this stuff at the wall. They're hoping to capture about 10% of the hard seltzer market. We'll see.
When I think Coors, I don't think seltzer. I don't think this one's gonna stick here.
Yeah, you never know. And then these are some of their non-alcoholic beverages. That Zoa is actually an energy drink by The Rock. Is like,
Yeah, that's my boy.
yeah,
All right. I don't buy brands. I try to save money, but I buy everything that guy makes.
I love
So I'm buying a case of Zoa. I'll help your position out, man.
it. Have you had it?
No, I'm super excited. I have like 20 boxes of Rain, which I don't know. I drink. I shouldn't be drinking these at all, but they're not.
Yeah. So, the one thing that they do have going for them is that they're still a profitable company. They still make money, and they're hoping to make a little bit more over the next couple of years because of their cost savings. They've been paying down their debt pretty steadily, which is nice. This free cash flow, the way they calculate it's a little bit different from the way I would personally, because they added back things that I don't think are necessarily appropriate to add back. Particularly the one that's most egregious to me is the stock-based compensation. Warren Buffett has kind of talked about that a little bit, about how really that's an expense. It should not be something that the company is adding back in the cash flow statement. They have to pay these people to retain the top talent in stock, and I understand and appreciate that, but it's truly an expense.
Yeah, I don't understand how you can argue how it's not an expense, because that's ridiculous.
Yeah, exactly. And they're not the most guilty of this. If you look at some of the high flying like tech stocks, like I remember seeing a recent analysis of DocuSign. They are one of the most egregious in terms of how much stock-based compensation that they're trying to say. Well, it's like that wasn't really an expense. Like, yeah, it really was.
Yeah, because you lose money. Yeah, it's ridiculous.
Yeah, exactly.
All right.
So they're also trying to be pretty disciplined about where they put this capital. Like you see that big bump up in their debt to EBITDA ratio, almost 5 there. They're slowly paying that down. They're doing well with that. They suspended their dividend in 2020 as part of the COVID pandemic, which I think was a positive thing for them. That freed up another $300 million or so in cash flow that they were able to pay on debt. They're expecting to be under the 3x like debt to EBITDA ratio by about 2022.
Okay.
Yeah.
All right.
Yeah. So this is what I was talking about before. Not only has beer declined as a portion of the alcoholic beverage market, if you see there, from 51% down to 48%, but if you look at the little snippet there below, these are both from Molson Coors 2020 annual report. Molson Coors has lost a portion of the beer market as well, from 26 down to 22% there. So they're getting a smaller piece of a smaller pie, like each and every year.
That's like a 20% decrease alone just for them.
Yeah, I mean, they are definitely, like I said, they're losing quite a bit of market share there.
Who's ABI?
That is Anheuser-Busch.
Oh, okay, all right.
Yeah. Budweiser.
Who are these other shares that are actually doing better?
Yeah, that's the microbrewery. Microbrew's hot. That's been eating into their sales there. Like I was saying, I went out last night, had a little dinner, and I had 2 microbrews. I didn't ask for any brand name stuff. All
right.
Yeah, exactly.
Shop local.
Yeah, shop local. You get some interesting takes. All right, so we're going to break down into the financials here. This is interesting to me. So I put this whole thing together. This is looking at 10 years of the financials of the Molson Coors Beverage Company. So we have their revenue each year here. You see this big bump up when they completed the entire acquisition of the Miller's Corporation there. But it's then slowly kind of bled down over time, notably here 2020, obviously the COVID pandemic. It hurt a lot of people. Their off-premise sales were actually up on their core brands. I want to say one of them was like 6% increase. One of them was 8% increase. I can't remember which ones, but the on-premise sales were down significantly, as you can, kind of surmise. People weren't sitting at bars or restaurants or sporting events and concerts having a couple of beers. So where they were selling their alcohol really changed a lot last year. So the next column over here is their EBITDA. So earnings before interest, tax, depreciation, and amortization. Ultimately, that's kind of a good proxy for cash flow because earnings can be manipulated a little bit more about those non-cash charges like they actually had last year. Like I was saying, where they wrote down the value of some of their brands, particularly in Europe. So they had negative earnings, but they actually were positive EBITDA. EBITDA growth has been pretty consistent, but overall not a great trend here where you're looking at a decline. Debt, like I said, it kind of picked up quite a bit back when they completed that Miller's acquisition. Not only did they dilute shareholders by issuing shares, they also took on a bunch of debt. They've been slowly paying that down over time, which is a good thing. Solid. Like I said, we want to ideally get that debt to EBITDA ratio back under 3 so that free cash flow will be truly available to equity holders.
Right.
Investments, they had some back at one point before they completed the acquisition of Miller's. They owned 42% of it. And they bought the other 58%. So now it comes all on the balance sheet. But no more investments. Market cap, this is simply calculated by finding the number of outstanding shares, and I used the closing price on December 31st of that year. So they peaked out in terms of market cap at almost $20 billion. Same year, their enterprise value was about $31 billion. Enterprise value is simply the debt plus the market cap. Imagine you have a house. The house is worth what your equity is plus
what you owe.
Yeah, exactly. So this is the enterprise value column kind of represents the total value of the business. If we're completely debt free, it would have been worth $31 billion at that point in time. It's now down to about $18 billion in value, 10 of which is represented, or almost 11, by the market cap. The rest of that is debt.
Yikes.
Yeah. Enterprise value to EBITDA ratio looks at how many years would this business basically take to pay you back? If you bought a business and you're looking at how many times the number of the amount it produces every year you have to pay for it. Like you can buy a pizza shop for like 3 times EBITDA, right?
Right.
This is big company. It's publicly traded. I don't have to go down there and figure out my own secret sauce recipe or anything like that. So we pay more for big companies, right? But been about 15 EBITDA, which is fair, nothing crazy, but just we're going to use that number again in the future when we calculate some stuff here. So debt to EBITDA, like I was saying, this is the ratio of how many years it would take for them if they put their entire income towards their debt to pay it off. They were all the way up to 5 times, 6 times, and they're paying that down slowly. They're planning to get it under 3x by 2022. The reason why 3 is important is 3x EBITDA is kind of considered the highest tier of debt amongst the company. If you start taking out more than 3x, you can go up to 5x, and for certain interest rate, yeah, exactly. And you start going over 5x, and look out. So, if you look back here at the EBITDA, we're looking at a negative 1.8% or so average of the last 3 years. We're going to use that number going forward when we model the next 10 years. Come down to this cash flow analysis here. So, cash flow kind of similar to EBITDA, but not exactly. We're looking at here is this is how much money they have left over after they pay their expenses, right?
Okay.
CapEx is how much money they have to put back into the business every year. So, you generate, $1,000, you have to put $100 into new equipment. The $100 represents your CapEx. You have $900 now of free cash flow.
Got it.
Now, free cash flow has to do a few things. It pays back debt is one of them, right? The other thing you look at is when we start to break this down in terms of how much of the free cash flow is pertinent to each equity holder. I calculated it 2 different ways. Now, this free cash flow per share here is calculated without any debt payments. So fair amount of money there. And we look at the yield here. When you're looking at that, you're looking at 10% or so free cash flow yield when they're not paying any debt payments, right?
That's
pretty solid. It means you paid $10 for this company, they're paying you back $1 every year in terms of yield, right? This is all theoretically your portion of the company. Now, when I adjust for debt, it's a very different story. Now, you look at some of these numbers over here, they're even actually negative. Sorry.
Oh. Can you hear me?
I can hear you. Yeah.
Oh, just keep going.
Yeah. So when I do the math here and figure out what the actual yield is at that point, we're looking at things that are often even negative. So that's not really great in terms of your yield at that point. Now what I did is I went ahead and extrapolated this out, looked at this free cash flow, and I predicted it using that negative 1.8% per year. And I determined then using this 10% approximate yield, what I think the share price would be in approximately 2030. So that predicts a share price of about $53.60 a share. And if you look at it all the way out here. Now we calculated it another way. I used the Ebitda and took reduced that at about the negative 1.8% per year, meaning they'll have about $1.2 billion in Ebitda in 2030, give them a 15x multiple there. So I calculated an enterprise value of about $18 billion. I subtracted about 3x Ebitda in terms of their expected debt to have is still remaining at that point in time, given the market cap of about $14 billion divided by the number of shares outstanding, gives me a predicted share price of $66.42 a share.
That's 2030?
That's for 2030. Yep, correct.
Eesh. Also, I fixed my camera. I don't know what happened.
Yeah, it's all good. So I averaged the two share prices together here, right on this area, and I figured about a $60.01 share price for 2030 is my predicted thing using both the free cash flow yield and the the Ebitda market multiple valuation methods. Right.
Oh.
Now we take that predicted price of $60 a share. I put it down here for 2030, and I'm going to look at this string of cash flow that the business is going to generate in the interim here. Right. I'm giving them no credit for any cash flow they generate in 2021 because they're still above that 3x debt to EBITDA ratio.
Right.
The cash flow is still going to be going to pay debt to get it under that ratio. Once it hits that ratio, I allow the free cash flow to fall through to equity holders. Now they can kind of give this to equity holders in a couple different ways. They could pay dividends, which is something historically Molson Coors has done. They could actually buy back shares, which is something I love to see, but they have not historically done it, but they will have the ability to do so at that point in time. They could also try to go out and acquire more companies to get their revenue growing again. I would not like to see that unless it was a slam dunk acquisition. They have shown that their prior acquisitions that have really burdened the company for the of the last several years. It's
not really killing it in that category.
Yeah, going through acquisitions is tough, because you have to pay such a premium to buy the company outright, and then you have to pay down that debt that you took on. It's less than ideal. Unfortunately, businesses love doing it because management, gets all the grand ideas, and the investment bankers are more than happy to tell you it's a good idea, right? Because they get money from fees when they do that. So it's tough. I think businesses should really stay away from acquisitions more often than they do. But anyways, so like I was saying, you put in $52.27 a share, which is the current share price as of today, which is April 24th, 2021. And you get the string of cash flow coming forward. I decrease this at a negative 1.8% per year. And then sold the shares basically in 2030 at $60 a share. So what we do is we calculate the gain basically. So this is that cash distributed. This represents both your dividends and also theoretically maybe some share buybacks. And then the stock appreciation right here is $7.74. Don't really expect the stock price to move a whole ton unless they start doing share buybacks. Now you're looking at a $54.28 a share gain between the cash flow that's pertinent to you as an equity holder and the market kind of a return there. So it's about 104% over the next decade, which is about a 10.4% per year, which represents approximately like an average market return. The 10.4% per year is in line with what the S&P has done historically. So
that's best case scenario, right?
Yeah, well, it's fair case scenario, I would say. This is about middle of the road. I wouldn't say this is best case scenario or worst case scenario, but it's pretty consistent with what I think they will do based on their historical results. I'm not giving them credit for any sort of like crazy, take off in the Topo Chico line or like this marijuana infused drink thing. I'm giving them no credit for that. But I didn't, also handicap them tremendously. Like their, sales, their EBITDA has been falling about negative 1.8% per year. That's really what I carried forward. So it's a lot of risk to be invested in one single stock. and only earning a market average return, because
Right. Yeah.
if I was only going to earn 10%, I'd much rather be in like a S&P 500 index fund than
Yeah,
I'm
it'd be a lot safer. Your risk would be way lower.
exactly. Yeah, I'd be more diversified. So from my standpoint, this Molson Coors Beverage Company is not a great investment at this point in time. So I disagree with the big dog, Michael Burry.
Unless he's swing trading it,
yes,
then it's good.
yeah. People consider Michael Burry a value investor, and to a degree, he certainly is. But I don't think he has the typical value investor time horizon. He seems more like what we call like a deep value kind of guy. The both Warren Buffett and Phil Town have said that typical value investing thesis takes 3 to 5 years to kind of merit itself out. So his timeline is usually much shorter than that. His average turnover is about 130% or so per year. So his holding time for most of his business is less than a year. He's not looking to be married to a stock for 3 to 5 years.
Yes.
Yeah. So, I mean, like I said, deep value play, I think this was reasonable. I am actually in this position. I'm up about 18% or so, but I will be selling my shares and looking for more opportunities. See our Alibaba video above.
Yeah. Alibaba's, yep.
Yeah.
I'm in that.
All right. Well, yeah. Well, thanks for tuning in, guys. We'll hope to catch you on the next one.
Have a good one.